Anticipation of decisions by ratings agencies Fitch and Standard Poor will dominate markets this week, overshadowing several other economic data due for release. The two agencies are due to announce their latest ratings on Friday. Economists have mixed views on how the agencies will rate South Africa. The country's weak economic growth, high unemployment rate and large budget deficits forecast for the next 2 years are among factors that support a downgrade. Now, to look at the prospects, we are joined in the studio by John Loos, who is property and household strategist at FNB. Thank you very much for joining us.
Pleasure, Colin.
If South Africa were to be downgraded, what should the specific reasons be?
I think at the moment there's big concerns about government finance. We have seen a wide budget deficit since the end of the boom years in 2008. That's caused the debt to GDP ratio of government to be steadily rising. And while it's not at crisis levels yet, eventually you get to a level where you've got too much debt, you struggle to repay it, interest crowds out other expenditure in your budget, and you start to have problems. So I think that what the agencies would like to see in the near, not too distant future is Treasury being able to gain control over expenditure growth. The wage bill growth in particular, it's a big one, and to start to turn that fiscal deficit around and flatten that government debt as a percentage of GDP out. I think that's crucial, but it goes a bit broader because of that. Economic growth drives tax revenue to a large extent. So the weak economic growth then becomes a concern, and all the myriad of structural constraints in this economy that prevent us from growing at a decent rate.
Mm-hmm. Looking at the current economic atmosphere in the country, we had labor instability as one of the attributes towards the economy not performing well due to business confidence and the sentiment thereof regarding Eskom and load shedding. Now, many people would say if there's a contrast, if you are having the launch of Unit 6 of Medupi Station, why shouldn't there be brouhaha and excitement to generate and ignite positive sentiment on the economy, because there's no longer load shedding?
Well, I think with regards to the electricity sector, I think what markets would probably want to see is signs that Eskom's turning the corner in terms of the way it gets managed. The units at Medupi have been long expected for a long time. Eventually they will be completed. But electricity isn't a major factor at the moment, purely because the economy is very weak. And demand for it has dropped considerably. So, you don't have that pressure on Eskom at the moment for as long as the economy is weak. What the markets would really like to see, I think, is more signs or, I think the concerns at the moment, I've mentioned government finance, but it's also about, there's other things constraining the economy right now. I don't think it's electricity, it's labor, it's an unequal skills balance, an ongoing education crisis, I guess you could call it, and a lot of the labor issues, the social tensions which are becoming more severe and disruptive. You see a more aggressive strike action, often disrupting sectors such as mining, that constrains GDP, and the lower economic growth goes, the more it drives those social tensions up. So you run the risk at the moment of getting into a vicious cycle of social tensions rising, causing economic growth to deteriorate, and that causing social tensions to rise, and the situation can get worse. I think those are the big concerns at the moment.
Mm-hmm. Looking at the stabilization of the rand against the euro and the dollar, would you say that the way things have been happening now, in spite of the contraction of the import-export ratio, where is this taking the currency now? Because it's still very, very trading very poorly against the pound at the moment.
I suspect we might still be in for some more weakening periodically until such time, because the social tensions don't go away overnight. One has to see concrete evidence of, right, this economy, there's policy initiatives being put in place which are clearly going to drive growth to a stronger level, drive employment better, and the social tensions are starting to reduce. When you get to that hypothetical situation, well, hopefully it won't be a hypothetical one, at that stage where there's clear policy measures to turn it around, at that stage you might go into a situation of longer-term rand strengthening. But for the time being, policy is not clear, or policy turnarounds aren't clear at the moment. And then on top of that, if you look globally, weak commodity prices, those look like they're around to stay for quite some time. So commodity exporting countries will probably remain under pressure. And then the United States, it's widely speculated, is going to start raising interest rates soon. And that can also negatively affect the whole emerging markets groups, capital flows and their currencies.
Okay, Azar Jermaine earlier said that he predicts that there could be another inflationary pressure that we're going to be experiencing in the first quarter of next year. Well, given the low oil prices and the interest rates having been hiked recently, what should we expect on the downside for the consumer in terms of pressure that will be coming onto their pockets in as far as facing an imminent interest rate hike if the Fed decides to increase?
I battle to see that the pressures will be strong inflation. We do expect a very mild inflation uptick as we go into next year. But, at the moment, a depressed economic climate, low commodity prices across the world, doesn't look to me like in the near term there's major inflationary pressures looming. But yes, a mild uptick nearer to the target range. More significant is the weak economy and the spectre of more widespread job loss. I think that is the real consumer risk at the moment, rather than these mild upticks in interest rates and the mild upticks in inflation. That concerns me less than the risk of a recession.
All right. Well, John, thank you very much for your insightful analysis. I guess this story doesn't end here. We'll continue to analyze in future programs. All right. I'm still